really thankful for all of you to be here, spending time, your precious time rather. You guys are here, so we're very thankful. Now, my name is Ashish. I am a buyer's agent. I've got Shiv with me, who is a chartered accountant, and he does structures. So Shiv from RTO accounts, and I'll just quickly move on to the presentation without wasting any time on it, because we only have half an hour in which we are covering everything. So just bear in mind what we are covering is pretty much an overview of a lot of things rather than going into deeper details on any specific sort of agenda or topic. So what I'm going to talk about is our goals, vision, mindset, our finances, property, portfolio, growth, and cash flow and indicators. Again, from goals, mindset, and vision, we pretty much cover bottom-up approach. Again, bear in mind, it's a general advice. It's not taking into consideration your particulars or needs. If there's anything specific, please get in touch with the respective professionals, licensed professionals here. I would also like to pay respects to all the traditional landowners of NSW, Victoria, and Australia, particularly Gadigal of Eora Nation, who are the traditional custodians of Sydney. I also pay my respect to elders past, present, and emerging, and celebrate the diversity of Aboriginal people. And again, thankful to any of the Aboriginal and Torres Strait Islanders who are currently here or might be watching the webinar later. Awesome. So look, as with my mentor tells me, great minds think alike, and I believe great investors think alike as well. There's nothing without the mindset. So please bear in mind whenever we are starting with something, because there's the goals and vision is never complete without the mindset. So please have something in written what motivates you. It should be in front of you always. If it's not in the front, it's not motivating you. Also have something smaller which keeps you going, some hobby, some sort of Rubik's Cube. Property is my passion, and that's how I started. I followed my passion, and now my passion follows me. So I love what I do. Similarly, keep a note of small wins. If you enjoy spending time with family, do that. It's challenging times, it's difficult times. Mindset is very important. And if there's anything I can support you with, please feel free to get in touch. Awesome. Now, with mindset comes a vision. As with any goals, please have in mind a longer term vision and a shorter term vision. It can be as lame as having 5 properties in 5 years, or even 100K passive income in next 10 to 12 years, or $1 million in cash. But what you're doing to achieve that is more important. Once you have a vision in place, please split it into shorter term and a longer term vision. Have a plan in place, revisit the plan. Again, there's a quote which says, begin with an end in mind. I think it's very important you have your exit strategy plan while you're planning your start. Also, please bear in mind, everything keeps changing while you are on your journey, but having changing it midway still makes sense. So don't try to be a perfectionist, just start with it. With the vision and the goals and the mindset, the finances are pretty important. And that's what I've learned in my investment journey. First, you make more of what you are doing. So if you are in a job, just make sure whatever you're doing in the best way possible. You ensure you maybe your goals on job front could be you have to be a general manager in next 5 years. So please try to make more of what you have. Second is add an income stream, follow a passion, and then try make money out of it. If you're not that type of a person, you value your comfort, then have some hobby, as I've talked initially. But then the second thing is leverage with what you have, which means revisit your expenses, see where you are spending, what you are spending, and see if it's necessary. Of course, if it's necessary, you would spend. My point is we should definitely be looking at that just to make the maximum use of what we already have. And lastly, whatever we save, invest it wisely, irrespective of what your medium is. Cryptos, currencies, property, shares, whatever you do, please educate yourself or hire professionals and ensure your money multiplies. I read a book once, The Richest Man of Babylon, which simply says you keep 10% of what you earn for yourself, because you end up paying everyone except yourself every single time. Also, just as a note or a tip, remember at 7% per annum, your money would double in 10 years. So this is the power of compounding. So 20 years, if you start with 100,000, you'll end up with $400,000. I'll now cover growth versus cash flow. Now let's Shiv, before that, can you please move on to the Excel so I can show what the goals would look like? So bear in mind, people, now this is again something pretty lame, but I think it should give you a very good indication of what you should have in place. Now, say the left section of the Excel simply says, what income do you need? Now I've started with, say we start with $100,000. And then again, bear in mind, I've simply assumed that my returns are 4%. Right. So at 4%, which is average sort of return, even from property or your shares or whatever, fully franked dividends, whatever you're getting, without taking into consideration any equity. Please look at the right bottom section of the Excel, which says the total asset value we would need is $2.5 million. Yes. At an income of 100,000 pre-taxes, you fall, whatever bracket you fall on, your tax paid is about $23,000. So your income is $6,400 a month, which I believe is pretty sufficient. But what we need is $2.5 million in assets fully paid out, unencumbered, in order to receive this income. When you are starting, please bear that in mind. If you keep your goals to $150,000, the asset value moves to $150,000. Yep. So the asset value moves to about $3.75 million. Please bear that in mind. Whatever your asset value is, if you start today, it will take you 12 to 15 years to achieve this sort of amount. So again, goals are very important. Your strategy is equally important. Shiv, can we please move back to the slides? Yep. So now I'll talk growth versus cash flow. Again, just keeping time in mind. Now, look, the growth is, say, a value of your units that will keep growing or multiplying without taking rentals or cash flow or dividends into consideration. Say you bought an asset for about $10, and after 7 or 10 years, it's now $20. So your growth is about 100% there. It's very important how you see growth versus cash flow. If again, there's no best way to achieve it, or there's no right or wrong. As an investor, if I am tight on income, or if I have a family to manage, I would focus both on growth and cash flow. There's no reason why one should be chasing one versus the other. I believe a balanced portfolio is what you would need eventually. Now, growth helps you leverage, it helps you exit. Without the growth, there is no exit strategy defined. Now, why people feel growth is more important sometimes? Because the growth is inbuilt, right? So it's a built-in equity. If you bought something for $10 and after 5 years it's $15, your next growth would be on $15. So you're not taking any money out, right? Alternatively, cash flow is what helps you borrow more. If you are here to build a portfolio, you have to have a balance. The cash flow helps you sustain. It keeps your lifestyle intact. Equally, because cash flow is more money in hand, you need a due diligence to keep saving that money and ensure you're reinvesting. That's pretty much the difference between growth and cash flow. As an investor, I would love a balanced growth. Please have a look at the tips for a while, and then just, it depends what your situation is or what your strategy is. I've seen developers who are making 20% in each property, and after 5 properties, they're just getting their 6th one for free. So again, just depends, as many strategies as you're aware of. So either you educate yourself or have a professional in place who are working for you. Okay. My last part, which I was saving for the last, the growth indicators. Now, again, there are many indicators. There's a checklist of about 30 growth indicators nearly. However, what I'm going to cover is pretty much the basic growth indicators that I capture or I work on. The first one being days on market. This means So again, it can be on sales side and on rental side. Sorry. So what I would see is days on market being on the sales side. So if days on market for an area is between 20 or 25 days or up to 30 days, it's a very hot market. 30 to 50 days, it's a decent market. 50 days and over, it's a cold market, or say a buyer's market. Pretty much most markets these days are hot markets, whereby you see days on market between 15 and 30. And that does means if a property is coming onto the market, a less than average property may stay on the market for 1 or 2 weeks. And a more than average property will only stay on the market for between 3 days or between 3 hours to 3 days. How desperate people are would really depend on how they track or how they manage with the agents. The second is stock on market. Again, it covers two parameters. One is the listings on the market and divided by the dwellings on the market at that point in time. So dwellings would remain consistent. Say there are 2,500 dwellings in the market versus 25 listings each month. The supply here is about 1%, which is an indicator of a very hot market. Bear in mind, the indicators are always relative, right? So it's always best to see the indicators with respect to something, just to get the best value out of it. So listings versus dwellings, stock on market, anything around 1% is amazing, or less than 1% is the lesser the better. Between 1 and 3%, it's an indicator of a decent market. Anything more than 3% is just tread on caution basis. Most house and land markets that people are targeting or building consultants target, the stock levels stack between 6% to up to 15%. Just be very careful when people say stock on market or there's a huge supply. This is the indicator which you should be looking at. The third indicator I'd like to talk about is called inventory. Again, it's listings versus sales. The results is how many months worth of inventory is there in a market. Again, these indicators by itself is not the sole criteria. You have to look at least last 3 and 5 years worth of trends as well. Reason being, COVID has changed most markets in a very weird way. You go 3-4 hours away from a major CBD or an employment precinct, you still find these indicators way more better than even the metro markets these days. But how it treads later, just be cautious what your strategy is and how you want to tread with it. Now, inventory, anything less than 2 months is a very hot market. If it consistently is for last 1 or 2 years around 3 months, I think it's amazing market. Anything 3 to 5 months is okay. More than 5 months, it becomes a buyer's market or a cold market. So that's how I would track inventory. Now, the other thing, now there are many indicators, right? But I would like to close with following the infrastructure. The most famous being Sydney Airport, where $10 billion are spent. Now, infrastructure in itself is nothing. With infrastructure, it has to give some benefits even after it is built. That means number of jobs created, or they reduce the travel time, because time is money eventually, right? Which has happened in South Australia. There's a North Connector that has been built, which has reduced 10 minutes travel time to CBD, and the suburbs are booming like anything. The same thing happened in Queensland, Moreton Bay, Kippa rail line, or there's a university coming in Petrie. So there are two things when you see in an infrastructure. One, when it is being built, how many jobs it creates. After it is built, how many jobs it will create, or what sort of benefit it will bring to the community. And that's why in some states, when people actually start seeing the benefits, that's when you start seeing the property prices to rise. In some states like NSW, for example, the moment it is announced, you will start seeing investors flocking out there. Just as a last, I'm not covering vacancy rates, rent a percentage, council approvals in past few years or so. So That's pretty much what I wanted to say. If there's anything I can support you with, please note down your questions and I'm more than happy to answer at the end. Alternatively, you know how to reach me, WhatsApp, messages, whatever, but I'll definitely come back to you with the answers. I will now hand it over to Shiv, who will take over for SMSF and other structures.
Thanks, Ashish. Thanks for covering the first part, and thanks to all the attendees for coming along, and thanks to Ryan for organizing the webinar. So a disclaimer, the advice is general in nature and does not take into account your personal circumstances. For personal advice, please talk to your accountant or someone professional like Ashish, myself, or someone else. Our focus is to educate the clients like yourself so that you can make an informed decision. The best thing is to build a network around you, the network of like-minded people, so that they can help you to succeed. And that should include professionals that covers property advisor, someone like Ashish, loan broker who can guide you on your borrowing capacity, financial planner who can guide you on your overall situation, for example, insurance. When you are planning your retirement, you are planning your future, insurances are very important. So you might be having a huge debt. And what if something happens to the main income earner in the family? You still want your strategy to go ahead. You don't want your strategy to be stopped just because you cannot work or you are not there anymore. So insurance is very important on that point. Conveyancer, so that they can help you with the Section 32 searches, contract review, and the settlement of the property. Solicitors for legal advice, and the accountants to do the best tax planning and the best structure. So why is structure important? The structure is important because the property is a long-term investment. As Ashish also has said, the compounding shows its effect in the long run. If you look at a smaller picture in 1 year's time, 2 years' time, 3 years' time, it might not sound as important, but in the long run, the small cost spent initially might make a huge difference in the long run. And it might be too expensive after a few years' time down the track in the future to fix the structure. It might be too expensive. It might involve stamp duty and the higher cost. And the next major important point is asset protection. Depending upon your employment, your profession, or any other risks that you are associated with, you might want to cover your investments, which is the property that you're buying. But if you are in a risky profession and you are being sued, there are risks from employees, suppliers, everyone. You don't want to lose your investment, which is your property. So you might want to keep your investment, your assets separate so that you manage your risk accordingly. Next comes the tax minimization. So we need to legally pay the minimum taxes so that we keep the more after-tax money, which accumulates and which grows in the future. So you need to adopt the strategy which is best in your scenario to have the minimum taxes. Estate planning. The other important consideration is estate planning. What are your plans, as Ashish said, on the exit? How do you want to pass on the wealth to your next generation? This needs to be decided before you buy the property. You don't want to incur a huge stamp duty if you are passing your wealth just within your family. So a right structure might help in the beginning. What is the best time to discuss all these structuring options? Before you sign the contract. Otherwise, it might be a bit late and it might be expensive to fix the things later on. What types of options do we have? There are 4 more popular options, and I will cover 2 of them in more details. The first one is the individual, which is buy in your name or in joint name. This is the simplest, cheapest option, but not the best option. It does not give you many options for the tax planning or for asset protection. We generally think more about the tax, but asset protection is more important. In my professional experience, particularly dealing with the business people, their first priority is always the asset protection. They are happy to pay extra 30 grand, 40 grand to the taxman every year, but they want to protect their 2 million, 3 million portfolio. They don't want to bring any risk to that portfolio. So if you own something in your personal name, there is hardly any protection available. The second option is companies. It is not very popular either, purely for investment. It might be suitable in limited circumstances, where if you are running a business and you have the huge retained earning from the business sitting in a company, or if you are buying a commercial property, the company does not get the capital gains discount. As such, if the company sells the property, you might get if you sell the shares in the company, but the buyer might not be interested in buying the shares of your company. So you might miss the CGT discount. The other two options, which we will be covering in a bit more details, is the trust and SMSF. The trust could be discretionary unit or hybrid trust. SMSF is also a form of a trust, but it works slightly different to the other types of trust. Bit more details on buying the property in a trust. So if you are planning to buy in a trust, again, depends upon your personal circumstances, whether trust is suitable or not. First of all, it involves the initial cost for the setup of the trust. The benefits are you have the ability to share the profit, the income from the property within your family members. For example, it could be very suitable if you have adult children who are not working, or their income is much smaller than your income, or if you have parents who are the tax resident of the country and their income is quite low. You might be able to give the profit from your investment to the family members. The other thing that you need to keep in mind is the trust cannot distribute losses. The losses are not lost, but they stay locked within the trust unless your trust starts to generate some profit. Then the losses are absorbed first, and then when there are surplus available, the profits are distributed in the future. The trust gets the benefit of CGT discount. As we just saw in the company doesn't get the CGT discount. The trust distributes the losses. If the recipient is eligible to get the capital gains discount, the trust has the option to pass on the discount to the beneficiary, which is also the recipient. The other thing you need to keep in mind, the trust requires a separate financial statement and tax return every year. We will see the number comparison in a minute in a case study. The last option that we are going to discuss is a self-managed superannuation fund. I will not go into the basic details of this type of structure, but this is a very special structure. You manage your retirement money. This is your retirement planning. You can roll over your industry or retail super fund and then use that money to invest into the property. Of course, it involves the initial setup cost similar to the other type of trusts, but the SMSF gives us many tax benefits during our working life and after our retirement. Any income in the super fund is taxed at 15% until you retire, and after the retirement, it is completely tax-free up to a certain cap, which is quite a large cap. Currently, one member can have up to $1.6 million, which has slightly gone up this year, again 1.7, and they would not have to pay any tax on that money after retirement. So for a couple, it could be 3.4 million. But there are certain limitations in the SMSF. There are limited lenders in the market who lend to SMSF for the property acquisition. You need at least 20% or for a good rate, 30% deposit before you think about buying the property. And when you buy one property, you cannot use the equity in that property against the acquisition of next property. This is a strategy which is very good to use and is quite common in the other type of structures, but it doesn't work like that in SMSF. If you want to buy a second property, you need to have enough deposit, 20 to 30% deposit, separately for the second property before you go ahead for the acquisition. But overall, it is a very good tax planning option. You contribute the money to the super fund and get the tax benefit as well, while you accumulate deposit for the acquisition of the next property. Overall, when you set up SMSF, in the long run, as your balance grows, you get the benefit of the cost savings as well. Because you have a super fund anyway, while you are working, your employer puts the contribution, or you make the personal contribution to your existing retail or industry super fund. Those funds charge as a percentage of your balance. So the higher the balance, higher you pay. Give and take, they take around 2%. So for a $200,000 balance, you're already paying them $4,000. But whereas if you set up an SMSF and buy property, you start saving on that cost as well. You don't need any professional advice after you buy the property. You still need to do the financial statements and tax return. And that is actually half the cost, even at the $200,000 balance, should not be more than $2,000. And imagine as your balance grows, your saving grows, which is invested within your super fund and accumulates. Now, if we move to the calculation, the case study, I have prepared a dummy case study where we are starting with a couple. They purchased a property in Victoria in Truganina for $520,000 in 2017 dollars. The couple are in roughly around, they are 40 years old. They have 2 children, 7 and 4 years. These are the actual prices that we have obtained from the real estate. They purchased in 2017, but this is the real prices in 2012 and until 2020. We are assuming that the rental income, the yield will be around 4%. That is standard, as Ashish also said. And we are expecting a price growth of around 5% in the area. Based upon that, the property, we are expecting that the couple will sell in 2042 for roughly 1.7 million. Now we will apply these numbers to see what result we get. First, if they buy the property in their personal name. Second, if they buy the property in a trust. Or finally, if they buy the property in super fund. This is a rental summary, which is again standard. No matter who owns the property, you are going to get the same rental income. We have allowed for the 4% gross rent less the interest. We are borrowing 90%, and we have the loan calculation. We are paying 2.7% interest, principal and interest, and we have allowed for the depreciation, and we have allowed 22% as the other deduction, which includes your council rate, water rates, repairs, insurance, bits and pieces. Net income, the net rent you will be receiving, it is going to be negatively geared for tax purposes for the first 4 years, and then the property starts to generate a positive income. So let's apply these numbers to the different scenarios. First, the couple owns the property in their personal name. In the first 4 years, while the property generates a loss, they get a negative loss, negative tax gearing benefit, a higher tax refund in their tax return. And then they start to pay income tax as the property generates income. As assumed, in 2042, they sell the property. They make a $675,000 capital gain after 50% discount. And we are using just the 2021 tax rates. We don't know what the tax rates are going to be in 2042. So assuming the highest bracket, they will be paying 45% tax on that money. So overall, in the 22 years of holding the property, the couple has paid $447,000 in income tax. Second scenario, if the property is owned by the trust. As we discussed, they have 2 kids who can also get the distribution from the property when they turn 18. The first year, we have allowed for the setup cost of the trust, and then the regular compliance cost, which is the accounting and tax return for the trust every year. First few years, trust is generating a loss. It cannot distribute that loss. And then in 2024, it starts to generate a profit. The prior year losses are absorbed first, and 2028 was the first year when it absorbed all the losses and there was a profit distribution possible. That distribution was given to the couple. They received the money. Trust must flush the profits out, and the couple paid 3,000 roughly income tax on that money. In the following year, they have a $12,000 worth of positive income, and their child one turns 18. So the child one is adult. The adult child is still studying, not working full time. So they gave all the distribution to their child. Next few years, they keep on doing that. And then in 2032, second child turns 18. He also started to get some distribution. The first child, when he was 25, got a full-time employment. So we stopped giving him the distribution, but the second child was getting some distribution, or the first child was paying tax. If he was getting the distribution, he was paying tax on the money, and so on. Keep in mind, even if your child is employed after 25, but their income might be much lesser than your income. The other thing you keep in mind, you lost the benefit of negative gearing in the first few years, but it is not a lost benefit. You absorbed all that in 2028, and your income in 2028 is very likely to be higher in 2019 or 20, because our income keeps going up. So you lose the benefit now, but you probably get a higher benefit in the long run. In 42, they sold the property. All the capital gains were distributed to the parents, and then they are paying tax at the highest margin rate of 45%. Overall, they paid $382,000 worth of income tax between all the family members. So that is a bit of a saving compared to 447, but that saving comes at the accounting cost, include the setup and compliance cost of $57,000. We are doing the calculations for one property. If you have a portfolio of multiple properties, this cost is not going to multiply by the number of properties. So the real tax saving for one property might not be huge. It's only 7,000-8,000 over 20 years. But for a multiple portfolio, it is a big saving. Plus, it gives you a benefit of the asset protection. As we discussed earlier, the tax saving might not be your priority at all in the next few years. Your priority might shift to asset protection when you are in a risky profession or there is any other risk. Plus, with a corporate trustee, it gives you the option of estate planning. If you have a corporate trustee to the trust, you might bring in your kids as the directors of the trustee, and you can pass on the wealth to your next generation if you are deciding not to sell the property. So these are the other benefits you might have. And to be on conservative side, we have limited distribution given to the children, and we have not given any distribution to the parents. So all that will add extra to the tax saving. Now, if we move next to the SMSF, the same couple, same property, they established an SMSF and purchased the property. As we just discussed earlier, the SMSF loans are slightly expensive and there are limited lenders. So we are generously allowing extra interest that the super fund would have to pay. We have allowed the 50% extra of the actual interest, and we have not allowed for the accounting and the tax compliance cost of the super fund, because you are currently paying that cost in your industry super fund anyway. There will be a saving on that cost, but again, for the illustration purposes, we are not accounting for the saving in the tax cost moving to a SMSF. Same scenario, rental income for super fund is going to pay only 15% tax. In this example, we assumed that the couple turned 65 in 2042 when they sell the property. So they are retired legally. Even if they are working, they can be retired after 65, and there will be zero capital gains tax. Overall, if they sell the property, no capital gains to pay, they paid $53,000 worth of income tax to the taxman in 20 years. A huge saving compared to the first two scenarios, 382 and 447. The extra interest payment to the lender was $88,000 in 20 years. Adding that, even your total expense comes to $141,000 compared to $447,000, which is a huge difference. For SMSF, we have allowed another scenario. What if you decide to sell the property before your retirement? If you sell the property before retirement, it is not totally tax-free from capital gains tax. After discount, you will pay 10% tax on the capital gains, but the money will stay within your super fund. It is a retirement vehicle. You can sell the property, 10% tax, and then you can invest the money within your super fund. So we are here saying that the couple sold the property when they were 64, just before their retirement, and they paid 10% capital gains tax on the sale of the property. Even then, the overall income tax that they paid to the taxman is $188,000. Even with the additional interest, the total cost was $276,000. These illustrations, these calculations take into account only one of the strategies, which is the tax planning. It does not take into account your personal circumstances, the asset protection, the estate planning, which might be suitable, but we need to discuss that separately, which is not the part of this webinar. That's why everyone has different family circumstances, different personal circumstances, and every situation will be different. You should not just decide a strategy just because your plumber bought the property in a trust name or in a personal name. That is not a good reason to buy the property in that scenario. So that was what we were going to cover. Now, if you have any questions, feel free to